Hi everyone, this is Dr. Barry, and this is your first lecture for ARMIN 3007, Commercial Property and Liability Insurance, and this is Introduction to Commercial Property Insurance. Your text for this course is the CPCU 551 textbook, Commercial Property Risk Management and Insurance. It's edition 1, edited by Mary Ann Cook, so hopefully everyone has that by now. A couple of quick points I want to make about this course overall. The course is about managing property and casualty or liability risk. Casualty and liability are often used interchangeably in the insurance business. But the focus of most of the course is property. In the last few assignments, I'll be providing you a separate set of resources for the course. Also, I want to note that insurance is not the only way to manage risk, and often not the best way. While most of you had Risk Management and Insurance 3008 Business Risk Management last fall, and you're well aware of this fact, many of you have not. Though the focus of this course is on insurance, I want you to be aware that there are lots of other ways to manage risk. We'll talk about a few of those ways very briefly today, but we won't spend much time on them in this course. Also, I want you to know that this course is not just about managing risk for large companies. It's about managing Wall Street risk and Main Street risks alike. So let's get into today's assignment, Introduction to Commercial Property Insurance. And just to look at an overview of the different parts of the assignment, we'll start with looking at the steps to risk management, a brief overview of that. We'll look at commercial insurance policy formats, the standard and non-standard formats, in addition to starting to look at the commercial package policy in total. And we'll talk about common CPP, commercial package policy conditions, and then other conditions that are specific to the commercial property policy. So let's start with steps to risk management. The first step is to identify your loss exposures, and those can be categorized into property, liability, your workers, auto, business income, and personal or personnel for a business. Next, you're going to analyze those loss exposures. You're going to consider the frequency and severity of potential loss. Then you're going to prioritize your risks, and you must consider critical risks as well as important and unimportant risks. The next step is related, and that is to examine the feasibility of different techniques. So now that you've classified your risks into critical, important, and unimportant, considering the frequency and severity of loss, you're going to consider the various techniques available and determine which is most feasible. Which brings us to selecting the appropriate treatment technique. Your choices are avoid, retain, control, and transfer. We'll talk about those a bit more in a second. And then, of course, you're going to implement the appropriate technique, and you're going to evaluate, monitor, and review your risk management plan to make sure that everything is working okay and things haven't changed much. Let's talk about risk control techniques. I just said that avoidance is one of the techniques, which is pretty extreme because it means not engaging in the activity or not buying the asset at all because you believe it's too risky. And then there's loss control techniques, which include loss prevention, which is taking actions to reduce the frequency of loss, and loss reduction, which is taking actions to reduce the severity of loss. Also, there's separation, which is separating two important assets or activities. Duplication, which is having two different ways of doing the same thing or two different items of equipment or assets that can be used to do the same thing. And diversification, where you have different activities so that if one activity is damaged or destroyed or becomes unprofitable, you have other activities that are profitable that can counteract that. But before I leave this page, I just want to mention that, again, these were things that we focused on quite a bit more in ARMIN 3008, but we'll leave these now and focus on risk financing for pretty much the remainder of this course. And risk financing techniques include retention, which can be funded or unfunded. Funded would be setting aside money to pay for future losses. Unfunded would be just paying for losses out of cash flows. And then there's transfer, and of course the best example of transfer, although there's lots of others, is an insurance policy. Just before we move on, though, into the format of insurance contracts, I want to note that you must also consider perils, not just exposures like we talked about in the steps to risk management, when identifying risk. And that's going to become important as we look at the policies specifically, because most policies only cover certain perils. Common commercial property perils, specific now to property, are fire, windstorm, including hurricane and tornadoes, earthquake in some parts of the country, burglary, robbery, and employee theft, flood, and explosion. Now let's look at commercial insurance policy formats. First and foremost, there's the standard format. The Insurance Services Office, or ISO, and the American Association of Insurance Services, AAIS, forms are the most used standard policies. Most companies use either an ISO form or some variation of that, and some do use the AAIS, and then some will develop their own policies. Just a side note, throughout this course you will read or hear the text or videos refer to the Commercial Lines Manual, or CLM. This was established by ISO, and its policy writing rules that ISO established relating to the standard forms that are widely used by insurers. Of course, that is the ISO forms. These standard policies might be monoline, which is one coverage or one covered peril, or they could be multi-line, which covers more than one peril, for example, fire and wind, or fire, wind, and burglary. A multi-line policy could also be a package policy, which again is a multi-line policy with more than one coverage part. Let's look at, from the textbook, the commercial package policy. This is a sample commercial package policy and its components. This will be a page that I'll often refer back to because it's a great summary and depiction of all of the different parts of the CPP, or commercial package policy. There's also what's called an output policy, which is a single policy form that provides comprehensive coverage for an organization. Usually this is for a larger organization. Sometimes the output policy can be specialized for a certain type of industry, like auto mechanics or contractors. Now let's look at non-standard. These are termed either broker or manuscript forms because they're developed usually by the brokers, the surplus lines or reinsurance brokers, in-house. They usually are some variation or some modification of a standard insurance policy. They're used for high or unusual risks. Of course, many of you are taking or will take the 4008 course, where we spend a lot of time discussing the non-standard market, or surplus lines, or excess and surplus lines and reinsurance markets. These are also known as the non-admitted markets, and as I mentioned, the excess and surplus lines, as well as reinsurance. A good example of when non-standard policies are used is in the oil and gas industry, because it is such a high risk and can be unique risks, and also it can be a distressed risk. But let's look again at this sample commercial package policy. And I want to focus right now on common policy conditions, which is discussed at length in the book. This section is all about common insurance policy conditions. Let's first focus on common CPP, CPP being the commercial package policy conditions. These must be attached to every commercial package policy, CPP, and they apply to all coverage parts contained in the policy unless otherwise stated in the particular coverage part. Let's start with cancellation. Basically, this says that the insured may cancel at any time by mailing or delivering written notice to the insurer. The insurer may cancel as long as they give 10 days prior notice for non-payment of premium, or 30 days notice for all other reasons. Almost always, this is superseded by state law, which addresses acceptable reasons for cancellation. The next condition is changes. Any changes to the policy must be done by written endorsement, but in most states, the agent's verbal agreement to changes waives the requirement that it must be written. In other words, when an agent says something that changes the policy to the insured, these things need not be written. They actually become binding. And one thing you need to realize as I speak about each one of these, talking about the insured, it is the first named insured on the declarations page of the policy that has most of these rights and responsibilities. So when I refer to the insured as I'm going through these conditions, both the commercial package policy and those that are specific to commercial property, I'm mostly talking about the first named insured on the policy. Next is examination of books and records. The insurer can audit the insured's books and records as long as they're related to the policy during the policy period up to 3 years. Usually these things are related to calculation of the premium, which is based on things like payroll and size of assets. The insured is required to submit reports to the insurer, but the insurer has the option of doing on-site audits. Next, inspections and surveys. The insurer has a right to physically inspect the premises and operations of the insured. However, they do not have an obligation to do so. They can also hire another organization to come in and do the inspections and surveys. They're allowed to make recommendations, but they make it very clear in the policy that they don't certify the safety and health of the conditions of the insured premises or operations. One thing I didn't put here is premiums. Payment of premium is the responsibility of the first named insured. And lastly, transfer of rights and duties under the policy. This simply says that the rights and duties cannot be transferred to another person without the insurer's consent. In other words, if you sell your business or your building to another person who is now the first named insured, the only way that it can be transferred to that new insured is if it is consented to in written consent form by the insurer. Let's look back at our commercial package policy. I want you to look at all the different types of coverage that are in this policy. The commercial property policy, commercial crime, commercial inland marine, equipment breakdown, commercial general liability, and commercial auto. We'll be studying all of these during this course. And note that each one of them has its own declarations and its own coverages. The coverages, though, to the commercial property include building and personal property coverages and the business income coverages. There's also a cause of loss special form. Each one of these last three will be a chapter in this textbook. The commercial property conditions is what we're really focusing on today in the rest of this lecture. So let's talk about those. First of all, our common commercial property conditions, and these can be seen on exhibit page 1.2 in your textbook, starting with concealment, misrepresentation, and fraud. Any intentional concealment or misrepresentation of a material fact related to the policy and fraud will void the policy. Next is control of property. When the insured doesn't control the property, an act of neglect by someone who is in control of the property, such as a tenant, will not affect coverage. Next, insurance under two or more coverages. This is referring to when two or more parts of this policy cover the loss. The policy will pay no more than the actual loss. Next is legal action against us, which is the insurer. An insured must comply with all policy terms before being able to bring legal action against the insurer, and this must be done within 2 years of the date of loss. Liberalization. If an insurer adopts a provision that broadens coverage within 45 days of the inception of the policy, that requires no additional premium on the part of the insured will automatically get the benefit. Next, no benefit to bailee. If there is a covered loss while someone has care, custody, and control of the insured property, the insurer has the right to recover from that person, the bailee. On the other hand, the insurer does provide coverage to the insured for property that is in their care, custody, and control. Next is the other insurance provision. If more than one insurance, and this is talking about another insurance policy, a separate policy, usually from another insurer, if more than one insurance with the same terms and conditions covers the loss, this policy will cover the loss on a pro rata basis. In other words, if insurer A and insurer B both cover the same loss, and the insured has $500,000 of coverage from both insurer A and insurer B. You take the $500,000 divided by the total amount of coverage of $1 million, and that will yield 50%. So each insurer will be responsible for 50% of the loss. If another insurance policy has different policy terms, this policy covers the loss on an excess basis. Next is the policy period and territory. The policy usually begins on 12/01 on the date shown on the declarations page. In terms of the territory, property is covered as long as it is in the U.S., Puerto Rico, and Canada. Unless otherwise stated through an endorsement in the policy, property is not covered outside of this territory. Last is the transfer of rights of recovery against others to us. This is the subrogation condition of the policy, which you should have learned about in ARMIN 2005. And it basically says that after paying an insured for a covered loss, the insurer can recover from a third party who was responsible for the loss, usually legally liable for the loss. Now let's look at other common property policy conditions. The first is valuation, and this deserves its own space because it's an important concept and takes a few minutes to explain. First, there's actual cash value, which will be explained in a slide coming up. There's also replacement cost, which is the cost to repair or replace property using modern and current materials. One of the things that an insured must ask is, does coinsurance apply? If so, it will be important in setting how much insurance you purchase, and we'll look at coinsurance in just a minute. Another way of valuing property is to value it at its selling price. So in other words, what could that property be sold for today? That type of valuation is usually added by endorsement, whereas actual cash value and replacement costs are usually on the declarations page of the policy. It's generally used for finished goods that have not yet been sold. There's also agreed value. This isn't in the text, but later in the course we'll talk about times where agreed value is used. Let's look a little more at actual cash value. First, it's defined as replacement cost less depreciation. So that using actual cash value is going to give the insured less coverage than replacement cost. The older the property is, the lower the loss payment will be. Depreciation is based on the remaining useful life of the property. Many states adhere to what's called the broad evidence rule in determining the actual cash value. This means that every indicator of value should be considered in determining that value. In other words, if a $10,000 piece of equipment is deemed to only have $500 of value to that insured, and it was deemed to have 10 years left of use, the value of the equipment might not be depreciated as much. Often different valuation methods are used in one policy for different property. Often, for example, building will be covered at replacement cost, whereas contents will be covered at actual cash value. Now let's look at coinsurance. The basic definition of coinsurance is that it requires the insured to purchase a percentage of the value of property in order to be fully insured. This percentage is frequently 80%, but the insured may be able to choose the percentage. If coinsurance is 80% and you purchase less than 80% of the property value, payment on any partial loss will be less than 100%. Let's look at an example. Let's say the coinsurance percentage is 80% and the building is valued at $500,000. That means that you must purchase 80% of $500,000 or $400,000 to be fully insured. Assume that instead you only purchase $300,000. In other words, you purchase coverage with $300,000 limits. All losses will be insured at the fraction of what you did purchase over what you should have purchased, or in other words, 300,000 divided by 400,000, which equals 75%. No loss will be insured, though, for more than $300,000, but all partial losses will be insured for 75%. A total loss of the building, which would be $500,000, would still only be insured for $300,000. Okay, now let's look at the last several other common property policy conditions, and those are insured's duties in the event of loss, which, first of all, this is a condition precedent in the policy, which means that these duties must be done or followed before an insurer is obligated to pay a loss. You can find these on page 1.24 of the textbook. But some examples of these are giving prompt notice of loss and filling out a police report if a law has been broken, protection of the property from further loss, like putting a tarp over a damaged roof, and writing up a complete inventory of everything that was damaged as well as undamaged property. Next is appraisal. If there is a disagreement about the value of the loss or the value of the property that was damaged, either party can demand an appraisal. Once one party has demanded the appraisal, both actually hire an appraiser who together select an umpire. And when two of the three of them agree on the value of the loss, that is the value that everyone is bound to abide by. Loss payment. The insurer usually has an option of replacing damaged property or paying the value of the lost property. Recovered property. The insured, as well as the insurer, may demand return of recovered property, but if it is the insurer that recovers the property and the insured demands return of that recovered property, the insured must refund the insurer the amount they were paid for the loss. The insurer, however, will pay for the damage to the property that has been recovered. Vacancy. If the property has been vacant for 60 days, the insurer is not obligated to pay for losses caused by vandalism, sprinkler leakage, building glass breakage, water damage, theft, or attempted theft. All other perils reduce the loss payment by 15%. Next is mortgage holders. The insurer agrees to pay mortgage holders to the extent of their interest in the property, which is the outstanding amount of the loan, even if the insured claim is denied because of the insured's actions, such as arson. So in other words, if there is a mortgage or two on the property, even if the insured has actually been denied the claim because of their own actions, such as fraud, the mortgage holder will be paid for their interest in the property. Again, the outstanding loan amount. And lastly, loss payees, which is somewhat similar to the mortgage holder. Essentially, loss payees explains how others who have an interest in the property, such as a landlord or a company that leases equipment, will be paid in the event of a loss. And that's the end. Next, we'll delve into the actual policies.